Have you ever come across investment advice online that seems credible at first? Recently, I've seen some articles promoting the Rule of 42 that might make you think you're hearing from the ultimate experts. One author claims to be a former investment and commercial banker with 35 years of experience advising clients since 1991. Another boasts the title of head investment strategist at her firm. Sounds impressive. But I gotta disagree with their advice. In fact, I believe following it could lead you down a path of poor performance. So I want to break down exactly why their recommendations and advice like theirs demand closer scrutiny before you even think about following it. So this video is about an investment strategy known as the Rule of 42. This approach suggests that your portfolio should include at least 42 different equities and other assets across a variety of sectors. Remember that equities is just another word for stocks. You can choose to include more if you wish, they say, but the rule is to have no fewer than 42 different investments. The Rule of 42 suggests allocating between 2 and 3% of your portfolio in each different stock. I'm going to go quickly through the reasons why you should just ignore this rule and the people that may say it's a good idea. First of all, do they really expect people to pick and manage 42 individual stocks? That's basically asking people to run their own little mutual fund. If you've seen my videos comparing actively managed funds to passively managed index funds, you know that very few professionals can outperform a comparable passive fund. Sure, someone might get lucky for a year or two and think they're good at picking stocks, but when it comes to investing, confidence is not your friend. Even actively managed funds run by professionals with all the research they have fail to outperform comparable passive funds about 90% of the time over 10, 15, and 20-year periods. There's excellent data on this in the SPIVA reports, which comes out twice a year. If you want a closer look at those studies, check out this video right here. I'll link it in the description. Then there's the recent research report by Morningstar. Out of nearly 3,900 actively managed U.S. stock mutual funds and ETFs they tracked, only 13.2% beat a simple S&P 500 index in 2024. Their average return was 13.5%. That might sound decent until you realize the S&P 500 was up 25% in 2024. Let me take a quick moment to say I'd sure appreciate it if you hit the like button, maybe leave some comments below. It really does help the algorithm and support the channel, so thank you. So anyway, professionals struggle to actively pick stocks, but these people expect individuals to do it? The article goes on to suggest that you could just spend 2 minutes every 3 months reviewing each of your 42 holdings. So that's only 84 minutes every quarter when a company's earnings are released. They claim that's not much time to ensure your portfolio stays healthy, provides stable, steady, and increasing income. I'm sorry, but most individual investors aren't going to enjoy sitting and sifting through 10K reports, listening to conference calls, analyzing industry and competitive positions of each company, track their valuation metrics, or assess risk factors, both macroeconomic and company specific. And let's be real, even the pros suck at this. One study looked at over 6,600 stock market predictions made by 68 so-called experts over an 8-year period, and their accuracy rate was only 47%. You would have been better off flipping a coin. For example, Jim Cramer had an accuracy rate of 47%, and the former chief U.S. investment strategist at Goldman Sachs was only right 35% of the time. Now, with that track record in mind, this article goes on to suggest that investors should adjust their portfolios during seasons of strong earnings and expected outperformance, then switch things up again when the market becomes turbulent, overpriced, or risky. So basically, They're expecting individual investors to make market predictions and adjust their portfolios accordingly? Seriously? I guess they think individuals can time the market, but that's just bad advice. The truth is, just having a simple portfolio is best for most individuals. Warren Buffett agrees, and so does the founder of Vanguard, John Bogle. Warren Buffett just says investors would be better off just buying a low-cost index for the S&P 500. Then you own 500 companies and you don't have to worry about studying stocks or know anything. Tough to argue with that approach because, after all, look at the compounded annual growth rates of the S&P 500 over these periods ending in December of 2024. Last 5 years, up 14.54%. 10 years, 13.13%. 15 years, 13.89%. Over 20 years, again over 10%. Over 30 years, almost 11%. And over 40 years, 11.83%. Now, I do agree that diversification is a good idea. The S&P 500 is pretty well diversified, and it does span 11 different sectors of the U.S. economy. But it is heavily weighted towards the large companies and has roughly a third of its investment in just the technology sector. So if somebody wants more diversification, there are many low-cost, small-cap index funds to choose from. Here's just a few that you could pick from. Vanguard has one, VBR, Spider S&P 600 Small Cap Growth ETF, SLYG. Schwab has a very good one, SCHA. The iShares Core S&P Small Cap Fund, IJR. Okay, any of those would be fine. Maybe you like the idea of some dividends in your portfolio. Again, just go with an ETF. There are many good ones to choose from out there. Here's just a few popular ones. Schwab's Dividend Equity ETF, SCHD. Vanguard High Dividend Yield, VYM. Spider Portfolio High Dividend ETF, SPYD. Vanguard Dividend Appreciation Index, VIG. Those are just a few that you could pick from that are all very good. If you like the idea of having more international exposure in your portfolio, or maybe just want some bonds, again, just go with a low-cost ETF. Diversification doesn't mean you need to pick 42 different stocks. Most investors would be way better off just sticking with index funds and other ETFs. And honestly, when you're picking funds, there's no need to have more than about 3 to 5. I've seen portfolios with 12, 15, or even 35 different funds. The problem is they're not adding the diversification they think they are because most of those funds have huge overlaps. If you do like the idea of picking a stock or two that you really feel strongly about, that's fine. Just make sure you got 3 or 4 index funds as the core of your portfolio. Then maybe devote a small portion of your money to try and pick a handful of individual stocks or two. Just keep in mind, the stocks you pick are probably already in one of your index funds anyway. So when it comes to portfolios, you do want to be diversified, but keep things simple. Simple is usually better. Most investment mistakes are emotional ones based on either fear or greed. Keep things simple. You can't control the ups and downs or what may happen in the world, but you can control your savings rate, emotions, and the risks you take. The best plan is usually one you'll stick with through any volatility. So anyway, I hope this has been helpful. Thank you for watching, and I hope you hit the like button.